Hello, Janad Trust here. In this video, I'm going to break down a huge warning that Tom Lee has for investors. You got to do this ASAP. So let's get into it. So Tom Lee, a prominent market analyst, has issued an urgent warning to investors for 2025, highlighting both potential opportunities and risks in the market. Now, here are the key points of his warning. You have the market prediction. Lee expects the S&P 500 to reach 7,000 in the first half of 2025, but warns of a potential correction in the second half, with the index possibly dropping to 6,600. There's the historical pattern. This prediction is based on historical trends where two consecutive strong years are often followed by more challenging market conditions, right? And then you have opportunities, right? Like small caps. So Lee sees potential in small cap stocks, noting that they have underperformed the S&P 500 by 91% in the last decade. Before I proceed, hit that subscribe button and the like button if you are educated and entertained. If you're gaining value from this video and you got what you came here for thus far, hit that subscribe button and the like button now, please. In regards to Bitcoin, which is identified as a potential avenue for profit, AI and technology, Lee believes 2025 will be a pivotal year for AI applications, reshaping the entire technology sector. In regards to economic factors, interest rates, Lee suggests that even treasury yields above 5% may not significantly damage the markets. CEO confidence, right, is expected to recover, potentially boosting market sentiment. M&A activity predicted to increase, which could support equity markets. Now, in regards to cautionary notes, valuations. While not currently in a bubble, Lee warns that valuations could become a problem if markets fail to surprise positively. Market expectations, Lee emphasizes the importance of managing expectations, as disappointment can lead to market downturns. Now, here are the 15 stocks that investors should be very cautious about in 2025, along with the reasons for the concern. You have Verizon. Despite its high dividend yield of 6.80%, the telecom sector faces challenges from intense competition and high capital expenditures for 5G infrastructure. 2. Pioneer Natural Resources, PXD. While offering a 5.50% dividend yield, energy companies are vulnerable to fluctuating oil prices and potential shifts towards renewable energy. 3. Philip Morris International. With a 3.70% dividend yield, tobacco companies face regulatory pressures and declining smoking rates in developed markets. 4 is Simon Property Group. Despite a 4.66% dividend yield, retail REITs are challenged by the ongoing shift to e-commerce and changing consumer behaviors. Next, 5 is Truist Financial. So while benefiting from merger synergies, banks face pressure from potential economic slowdowns and interest rate uncertainties. 6, we have Devon Energy. Its variable dividend policy may lead to inconsistent payouts, and the company is exposed to commodity price volatility. 7, we have A.O. Smith. Despite being undervalued, the company may face headwinds from housing market fluctuations and economic uncertainties. You have Albemarle, ALB. The lithium producers' fortunes are tied to electric vehicle demand, which could be affected by economic conditions and competition. 9, you have Baxter International. So healthcare companies may face pricing pressures and regulatory challenges in a changing healthcare landscape. 10, you have Dollar General. While undervalued, discount retailers may struggle if economic conditions improve and consumers shift to higher end options. 11, you have Estee Lauder. So luxury goods companies could be impacted by changes in consumer spending habits and global economic uncertainties. 12, we have Kraft Heinz. So the food industry faces challenges from changing consumer preferences and potential inflationary pressures on input costs. 13, we have PayPal Holdings. So fintech companies face increasing competition and potential regulatory scrutiny in the evolving digital payments landscapes. 14, we have Under Armour. So athletic apparel companies may struggle with inventory management and changing consumer preferences. 15, we have Moderna. So biotech companies face uncertainties related to drug development pipelines and potential changes in, healthcare economies. Now, in regards to economic factors that play a role in this is sticky inflation, right? There are concerns about persistent inflation, particularly in the housing related costs and services, which could force Federal Reserve to maintain higher interest rates for longer. You have the interest rate uncertainty. So the Federal Reserve's approach to interest rates remains a significant factor, with market expectations for rate cuts becoming less certain. You have the valuation concerns. Stock market valuations are considered high, with the US market trading at a premium to its intrinsic value, leaving less room for recovery during market pullbacks. And there's also political and policy factors, right? So new administration policies. So the incoming Trump administration's proposed policies, including potential new tariffs, tax cuts, and deregulation, are creating uncertainty in the markets. Next, we have trade policy. So concerns about protectionist trade policies and potential implementation of tariffs could lead to market volatility and impact global trade. Lastly, we have fiscal policy. So worries about the sustainability of the US fiscal situation due to potential deficit increasing policies could surface throughout the year. If you had liked this video, hit that subscribe button and the like button. See you in the next video.